There's three things that we'd focus on. One is a clear plan on the power business. That's obviously been a big black hole at the center of the earnings of the company the last 2 years. I think we need to hear about restructuring there. Second, it would be a sense of GE Capital. How much has he looked through the balance sheet? How comfortable is he with the balance sheet at GE Capital? And the third would be a sense in which, is that June 2018 plan still intact, or is there a broad strategic reset coming, potentially changing the details of that plan they laid out in June?
How comfortable are you with the balance sheet of GE Capital?
I think the GE Capital...
It sounds like you think there might be some shoes to drop.
I think there are some shoes to drop around further risks at insurance, also WMC, the old mortgage business, and you have some charges coming from DOJ and SEC. On the other hand, there's a ton of industrial assets that could be divested to raise cash to plug those holes at GE Capital. I'd also say that Culp was known at Danaher for very consistent free cash flow generation, and so he can probably improve the free cash flow profile of GE Industrial. And if that happens, people will naturally feel much more comfortable about the risks at GE Capital.
Are they going to cut the dividend, and by how much?
We estimate they'll cut the dividend to about a 10-cent run rate next year. That's against the current run rate of about 48 cents, and obviously that's down from a 96-cent dividend
what does that give
18
them in
months
cash?
ago. So that would free up close to $3.5 to $4 billion of free cash. We think that that would be used for restructuring, particularly in the power business.
What's left of GE in 2 years?
Sure. So under the plan in June, and Culp was on the board when that plan was laid out under John Flannery, you would have shrunk the company essentially back towards power and aviation as the core.
Healthcare's gone.
Healthcare under that plan was gone. Baker Hughes under that plan was gone. It's quite possible you get a rethink of that June plan, though, particularly if that power cash flow is going to be weak for several years. It may make sense to think about retaining healthcare.
Who's buying power plants? That's the problem, basically, isn't it?
I mean, I think if you look at their installed base, they're in about 40% of power plants globally. So if you assume that in emerging markets, electricity consumption has some multiplier effect resulting from GDP still, you can still get an emerging market power plant build-out story.
You make the point in your note that aviation and healthcare is equivalent to GE's entire enterprise value. Does that mean that you think that that should be the core business in a couple of years when they pare down assets, et cetera?
It more meant to me that investors are essentially assuming that the valuation of all the other businesses, Baker Hughes and transportation and so on, all of that value gets completely offset by plugging holes at GE Capital. So in other words, I think it tells us that GE Capital, to a large extent, the risks at GE Capital are factored into the current share price.
You mentioned you think the dividend goes to a 10-cent run rate for the year. Is that because, and we had this discussion during the break, GE wants to maintain some kind of dividend so they can stay in certain mutual funds and ETFs that are dividend payers? And put that aside, do you think they should just cut the whole thing and preserve as much cash as possible?
I think having a token dividend probably makes sense. That removes the risk of forced selling by institutions as well as individual investors. And having that kind of token dividend, it costs a few $100 million a year versus their revenue base of well over $100 billion. I think it's worth retaining some small degree of dividend.